Good morning, welcome to Ainsley News. It's end of week, Friday the 22nd. Today we're talking perfect storm for gold with real interest rates. Maybe one of the biggest questions for 2021 is that of inflation. Late last year we discussed, and today we share a couple of charts that paint a very clear picture of rates and inflation expectations, and gold's historic performance mapped against that. Next, we're going to show a chart, somewhat ironically from the US Fed's own site, that maps out clearly what the bond market is telling us about real interest rates and how that is and has mapped against gold. As negative correlations go, it doesn't get more perfect. The blue line shown is the difference between the 10-year US Treasury yield and the 10-year break-even inflation rate. The latter being the Treasury market participants' expectations on the average inflation over the next 10 years. As a reminder, real rates are the nominal rate less the inflation rate. You will note we are deep in negative territory. So if your US Treasury note is yielding 1%, but inflation expectations are 2%, you will go backwards on your investment for each of the next 10 years by 1% per year. The historic alternative is gold. And this chart here shown next tells you why. Take a moment to have a peek at that. Negative interest rates don't necessarily rely on continued low or lowering rates of inflation if it takes off. Since August of last year, when the 10-year UST yield plumbed to all-time historic low yield of just 0.5%, it has been on a slow grind up and then popped up a little over the last month on the certainty of the blue sweep for the Democrats in the US. Here's that chart here, showing that ever so slight increase there in Jan 21 this year. Not uncoincidentally, gold has been on decline since that August bottom in rates when it hit an all-time high of US $2,062 or AU $2,860. But the nominal rate is only half the equation. Inflation is the elephant in the room, and despite the climbing yield, the first chart we've shown today shows it is now starting to overwhelm that rising yield as inflation expectations continue to surge, as you can see in this next chart here as well. See that bottom out there in 2020 and what we're cruising towards now with that inflation rate. The perfect storm is a Fed incapable of raising rates under a market reliant on stimulus and debt burden incapable of handling any increase in interest rates to service it. Coinciding with this is the spectre of inflation surging on the back of that very same stimulus, now about to be doubled down with fiscal stimulus from Biden-Yellen administration that is promising to go big, and they already have gone big. To be fair, there is the prospect of rising rates, as we've seen already, despite the Fed not raising the cash rate just through the organic bond market. That would likely mean the Fed has to be more aggressive in lowering the cash rate to counter those forces, which it knows will be destructive to this previous market. The US Fed has so far avoided negative rates, but the choice may soon be removed. Yesterday, the US 5-year real yield was a whisker of an all-time low. Crescat's Octavio Costa tweeted to this just yesterday. And here's that tweet here, saying, we talk about the 5-year yields about to make all-time lows. It's not about nominal rates threatening gold. It's about inflation expectation rising even faster. Macro drivers keep building up for precious metals, and supply shortages only add to it. Spot on there from Octavio. And that's this week's news. Remember ainsleyBullion.com.au for all things physical, ainsleywealth.com.au for cryptocurrencies. Might have seen a little dip there from Bitcoin last night. Could be an opportunity. And of course, check out goldsilverstandard.com for our own cryptocurrency built and backed by real physical gold and silver. We'll catch you Monday for more news.